Our next session is a very interesting one because we're moving away from macros to markets, right? And we're calling this a jugalbandi between two market masters. And they are really market masters in the true sense of the word, because between them, they've got some, I think, at least 80 years of market experience. They've seen the highs, the lows, they've seen crises, they've seen booms, busts, really experienced it all. I'm talking about Raamdeo Agrawal ji and Manish Chokhani, who are our next panelists. And this jugalbandi is between them, no pesky anchors in between. Raamdeo ji, really, I mean, actually, both of them need no introduction, but I'll just say a few words. I think Raamdeo ji is someone who is a passionate investor. He's got a childlike enthusiasm for ideas. I mean, I remember the first time that I met him, I came back with a list. And it was not a list which was basically made up of stocks or themes or anything. It was a reading list. So I consider Raamdeo ji first and foremost a teacher, a mentor. And his message to me, and I think others over the years, has been read every day, and you have a hope to succeed. So Raamdeo ji, thank you very much for your wisdom all these years. Really appreciate it. Manish Chokhani needs no introduction either. He's one of the most astute market investors that we have amidst us. His grasp on macros and markets and distilling the macros to the micros is, I think, unparalleled. He simplifies complex ideas guided by first principles, and I think that is where he really excels. So without further ado, let me request both Raamdeo ji and Manish to take the stage and, dare I say, entertain us with his jugalbandi. Over to you guys.
This is the scariest thing we've done, completely unscripted. And then Raamdeo went and put his foot in his mouth asking him about economic forecasts. What if they ask us about market forecast? He only missed by 100 or 150 basis points. We get it wrong by 10 percentage points.
But at least we can say we don't know.
So we can start off. I was at pains to tell Sonia that you're 10 years older than me. So you should have the first bite of the cherry, and you should kick off on maybe, as Shirin introduced in the beginning, you connect the dots backward. So how the last 40 years, because you've been there, I think, since the 80s. I came only in the 90s. So maybe, I say it with, not in jest, but because he saw the kind of 10x of the index in the first decade, and then the mania of Harshad Mehta and how that played out. And we may well be setting up for that. So I think we are both in sort of that camp. Maybe I'll leave it with you.
So actually, it's a terrific time to remember 1992. I mean, I have seen firsthand, actually, 85 was the first boom, which was VP Singh and Rajiv Gandhi combined. And that was a kind of mini boom. Just stock market just doubled in 1 year. So that was a small. And then came the 1990-92 boom. I think it is
He just said the market doubled in 1 year, just in passing.
But just listen to the second one. When the index went 6x from 700 to 4200 Sensex in 19 months flat, that gave birth to Raamdeo and Moti and into Motilal Oswal. So I started with zero money. I mean, literally zero negative rather. And we made 30 crores in 19 months. And that became the seed capital for Motilal Oswal. So, yeah, then came the next bull run was the Y2K bull run. Then came the GFC, the commodity bull run, rise of China. It was actually rise of China, commodities and everything. And then we had little lull and then pre-COVID. So my sense is what I've seen in 1992, this is 10x of 1992. We are into seriously very large bull run. The issue is this time there is a SEBI. There is an RBI with a complete digital system. They actually can see what badmashi we are doing. So with the police, the crowd will be a little limited, little disciplined. So my sense is eventually we'll run much more, but it will be a little prolonged. So my sense is that this is I think this is a retirement time for us. If this bull run,
for you, I'm 10 years younger.
Yeah, so you'll see another bull run.
So as Prashant said, I'll just supplement. As he said, it's useful sometimes to give context in which this is happening. And Keki will know this well also, that when we broke the Bretton Woods standard and the US started basically printing money and we all pegged to the dollar, every decade we had a mania in some market or the other. So in the 70s, you had the Nifty 50 in the US with the Disneys and the Kodaks and all. Sorry, that was 60s. 70s, then it goes to commodities, which is gold and silver and all of that. And the famous Hunt brothers. 80s, it went back into commodities and emerging markets. So that was the rise of Japan and Taiwan. And all these manias go up 10 to 15 times in one decade. Then we kind of got the tail end of that, of the 80s end, which really was Japan, Taiwan. And Harshad Mehta, I think, decided he wants India to participate in that. And the 90s, of course, went back to tech and US and the NASDAQ. And then the 2000 to 2010 period came back to commodities and emerging markets in which India, China all benefited. And that was the rise of our great bull run as well of the 2000s. The last decade, again, we saw 2010 to 2020 going back to financials, technology, the FANG mania. And that's why the supposition for most investors in the world is, again, this decade comes back to commodities and India. And to Samiran's point about how do we play this game this time. And fortunately, RBI keeps coming and keeping the market cool from the debt side. And SEBI is doing a great job getting the froth down. Because what you don't want is all the returns to be front-ended.
Don't have parabolic market.
Yeah, and then you have 20 years of a bear market which follows. Yeah. So if we
but
go
I think
up
10,
if we go 10 to 15x in this decade, that would resemble what happened to Japan in the 80s and what happened to China.
No, even India, 92 to 2002.
Right.
So that was a very bad period.
Yeah.
So
that's a good cue for you to now talk about the retail investor and the rise of retail in India.
So why I'm saying this is that rise of retail investor and the force of it, people have still not, now people are getting sense of it, but they have still not understood. Till 2020, we are getting about 300 to 400,000 customers per day, per month, at the industry as a whole. Come COVID, digital onboarding starts. No physical checkup for onboarding. In 5 minutes, you start your trading and all. And we start getting 4 to 5 million customers per month. 4 to 5 million customers per month. From 40 million demat accounts, now we have clocked 150 million. And I think this is 3 years story. And when you imagine 5 million customers a month, and these customers are cumulative in character. They're not flow, they are cumulative in character. And we are headed for maybe 300 million straight in 3 to 4 years. And maybe, I don't know what is the end game, maybe 10 years of 500 million. So this is a amazing stock market boom, stock market liquidity inflow into the market. Now what it does is, of course, it lifts all the stock prices, mid cap, small cap, large cap, anything goes. And last year, I think 23, 24, the return for across the portfolio, at least in my AMC and what I invest in generally, is about 50% across the portfolio. I'm saying I'm not about one scheme or one stock. I'm talking about the entire portfolio, extremely diversified. Literally, I bought the market. So that is 50%. So you imagine the kind of bull run which is underlying, despite all the restrictions by SEBI, regulators, and everything. So, and we have still done 150 million. Now you imagine people, when it was 50 million, the 50 million satisfied customers were there, and they were saying, brothers, come and enjoy the bull run. Now there are 150 million customers saying, boss, this is fun, lot of fun, please come. So you are getting not a smaller number of demat accounts, you are getting larger number of demat accounts. I have never seen in my office somebody coming and saying, sir, I have 500 crores fixed deposit, what do I do? Or 1,000 crores fixed deposit, what do I do? So this is the kind of shift which is going to happen from fixed deposit to the mutual funds or whatever, stock market.
The investment cycle is back. It's not happening on the ground, it's happening in the stock market.
What is going to happen is, my sense is, one is that stock prices are up. Then what happens is the supply response comes in. There's a demand response. Now there is supply response. So all the IPOs, you're seeing 50 times, 60 times. Then QIPs. But put together, they're just about 1 lakh crore. 1,25,000, 30,000 or something. the actual flow is almost 5 to 6 lakh crores and growing. So there is still, this year is second, third year, this is still excess demand than supply. So I don't know how fast. I would expect government to at least divest 1 lakh or 2 lakh crore worth of stuff immediately after the election. Obviously don't expect before election. And so after election, and but the larger corporates like Jio and all those big ones which are waiting in queue, 50,000, 1 lakh crore kind of IPOs, let that come. I think we are going to see all of them coming in. So I think the supply response should come, and that will broaden the market in a very healthy way. And so the fund will become even bigger. I hope that is what happens, but anybody's call.
No, it's again consistent with the phases of market which we see, where the profit cycle starts in one sector, then it spreads to another sector, then the P multiples expand, and then we start creating new stories and paradigms. Like 15 years ago, it was BRICS will be the new engine of the world. We are setting ourselves up to say India is the only large economy in the world of this size which has growth ahead of it, not in the rear view mirror.
What would be the investment theme? I mean, you are very good at...
So there are 4 or 5 things which, see, we are just copying what's happened in other countries. So it's nothing unique. We've all trod the path before. And if you look around the world, typically, as again Samiran was pointing out, when you get richer, you don't buy FMCG goods, you buy consumer discretionary. So you spend more money on improving your house, you'll spend a lot more on property, you'll spend on travel, you'll buy a better car, you'll do all your home improvement stuff, you'll go out to eat. So consumer discretionary is one very, very, very big play. Housing, of course.
So you start with that, but do you think it will never trickle down?
No, it will obviously, because each time when you build a home, there are 5 people who are supplying and 10 people who are servicing you. And India has this unique pyramid of that 2% Australians, 18% Filipinos, and then maybe 1 billion people living in Africa, and it will trickle down. And if I then see the math, for example, 20 years ago we were selling 1 million cars, same as China. We have barely crossed 4 million today. China is at 26 million cars. We sell something like 12 or 13 million air conditioners. China is at 220. So that's the scale of change which lies ahead of us in the next 10 years. So that's, of course, one. Second is, as the government privatizes effectively to the private sector. So you've seen effectively Reliance and Bharti have run the telecom infrastructure of India, and we couldn't have run the country in COVID if this wasn't there. Or Adani now runs the ports and the airports of India. Indigo, pretty much, Indigo and Tata will run the airlines of India. So all of these privatization beneficiaries will become very, very large. The profit size is very, very large over here. So that's item 2. You and I may not participate because these are not traditionally high return businesses, but you're getting the likes of Blackstone and others to come in. They're taking over even the commercial properties and building REITs. So that's kind of item 2. Item 3, I know we all enjoy doing the Zomatos and all of the world with the internet-enabled businesses can become very, very large in the country. And like you said, in your own field, the rise of Zerodha or even Angel and even yourselves, with what happens with the rise of internet and making life so easy for people, it just explodes the business. And I think we've been beneficiaries of that in our life as well. That clearly is number 3. But the biggest mega theme, and I'm sure Keki and Vaidya will talk about it, is financialization. We are a $4 trillion economy. We save 25%. There's $1 trillion of saving every year. Of that today, only half comes to financial assets. Half is still going to physically buying real estate or gold. So first of all, that has to get financialized. Within that, the share of the banking system has to become much, much larger. And I'm not going to do this because I'm sure Vaidya and Keki will do it.
Banking system will be larger?
Significantly larger. Let me give you one good stat. And although I know, you have a AMC and we both love the mutual fund business, but just for context, HDFC Bank today would be what, a $60 billion net worth for a bank which is 20% of India's banking system. And let's say it'll be a 600 billion odd balance sheet size. If you are saying this country gets to 5 and 10 trillion, and let's say we only want 15% compounding, which is 4 times. So HDFC Bank needs to get to $240 billion market cap. At a $240 billion market cap, $240 billion net worth, it will be a $2.5 trillion balance sheet, which is still very, very tiny for a country of this size in the context of a $10 trillion economy.
But do you think, yes, size will increase, but do you think the economics, will it be in their favor? Because
It will be because, like I said, you're taking share away from real estate and gold, then you'll take away share from public sector banks.
What about actually bank deposits going to the stock markets?
So I'm glad you asked. So let's again take the same math. The biggest mutual fund today, and I'm just rounding off, I don't want my friend in SBI to be unhappy, but let's say HDFC mutual fund is a $10 billion market cap. And let's say you want to compound at 25%, so you get to a $100 billion market cap. At a $100 billion market cap, at some point he will sell at 4% of AUM, more or less, which is what the world average is. Today it's priced for perfection. To get to 100 billion, now you multiply that by 25x. So he needs to be $2.5 trillion AUM. It is impossible. Whatever you do, it's not going to happen. So mathematically, you will make a better return in the bank than in the mutual fund, while the business will do better in the mutual fund. It will compound faster, but you won't make a stock return in it. As an example. And I wish Navneet well, I don't want him to come and beat me up, but both are friends. And I own both businesses today. But like I told you in our last Diwali interaction, that you will be 10x in 10 years.
But what we have seen in America...
The amounts are minuscule. And, Vaidya is what? He's 30,000 crore net worth today. And he's guided, so I can share it publicly. He's saying, I'll grow 25% for 5 years. So he'll be 3x in 5 years. At that point also, he's 90,000 crore net worth.
No, I'm not doubting your figures.
It's a drop in the ocean.
What I'm saying is a shift, the pace at which people are shifting their bank deposits to stock market side.
Yeah.
If it
I'm
is,
glad Nilesh just walked in. He missed all the mutual fund numbers.
So what I'm saying is, if by chance there is a 17-18 lakh crore accretion on the bank deposit side.
It's too tiny. That's what I'm saying. It's a trickle.
Listen to me. And just about 5-6 lakh crores on the mutual fund side or entire stock market side. If that goes to next year, 10 lakhs to mutual fund or capital markets, and deposit accretion only is 18-19 lakh crores. Then what happens to the cost of deposit?
You see, it can be a circular argument. We can argue it won't happen and therefore the cost will go up. I'm just giving you the aggregate numbers that banks may be 80%, mutual funds may be 20%. Over time, the mix will change. But the country is still compounding at a certain rate, and you're still taking away share from real estate and gold. So it's not one is winning at the expense of the other. And I'm saying mutual funds will compound 25%. Banks need to only do 15%. The end point trajectory still, you cannot imagine a HDFC mutual fund at $2.5 trillion at that point. But you can imagine it for the bank. It's a done deal.